All right. Well, welcome everyone to our latest opportunity. We got a great turnout so far tonight, and the room is continually filling up. I'm Gary Lipsky, founder and president of Break of Day Capital. We're excited to start off the year with what we think is a heck of a deal. It's been over a year since we launched our last deal, Icon and Headley. Certainly, it's not without trying. We came very close on a few deals. We won a couple of deals. The seller backed out because they were going to lose some money. We had one in escrow, and we dropped out of that one because the due diligence, didn't go as well as we had hoped. But patience pays off, and we got this off-market deal for 110,000 a door, which is a great basis. So we're thrilled to get it at that price, and it cash flows nicely right out of the gate. It's a little over a mile from one of our properties and within a few miles of three of our others. The property is called River Oaks, and we would change the name to Icon on Broadway. And the most important box that this deal checks is asymmetric returns. We feel we've really de-risked it extremely well and has excellent potential for upside. And over the next 40 minutes, Tim, Joe, Andy, and I will go over the details about Break of Day Capital, what we've done, our focus, and all the major things you should know about this opportunity. And we know your time is valuable and you have investing choices, so we appreciate you taking the time to watch this webinar. As you know, we are recording this and it'll be uploaded to the portal, where you'll also find the deck. Give us about 24 hours or a little less than that to get it up there. If you have questions, feel free to put it in the Q&A, and we'll answer those questions at the end, as many as we can get to. And if you think of any questions after the webinar, don't hesitate to reach out to myself or Andy or Joe. We'll be happy to answer any questions you may have. So without further ado, let's get started. All right. So we have our disclaimer. Please make sure you read it. Obviously, you're not going to read it in time for this when I change it, but it'll be in the deck when you can revisit. Here's another slide on our disclaimer. Basically, it's saying we're not providing legal, investment, or tax advice. Please seek out professionals for consultation. All right, so a little bit about Break of Day Capital. We've raised over $100 million in equity over the years. We've distributed over 40 million to our investors. We focus in the Southwest. We're not chasing deals all over the country. We're very focused. We've acquired over 1,800 units over the course of our company, with a total value of over $320 million in real estate transactions. And we really focus on asset management. I literally wrote a best-selling book on it. I had a podcast on it. Now the podcast is more broad-based, but in our first 11 deals, we've averaged a 40% bump in NOI in year one across our portfolio. The last two deals were more of a core basis, so there wasn't as much upside to be had. And this is one of those as well. We moved kind of away from these massive value add deals and more on a core plus, so that gives investors more cash flow. So it's not just me. We have a great team, a team that has a ton of experience. As you can see, Tim is our director of asset management, also acquisitions. Joe, if you don't know Joe, he's invested in at least 10 of our deals, started off as an investor, is a specialist in macroeconomics and data analyst. We also have Sean, director of operations, Jacqueline, operations manager, and Andy, our investor relations manager. So a huge breadth of experience across our board, and they all participate when we're looking at deals, and most invest on a per deal basis as well. And that brings me to alignment of interests. So for Tim, he's not just helps us with the acquisitions, but asset manages the deal. So he's not just handing it over; he's seeing it from cradle to grave. And grave, I mean, as when we sell the deal. So his interests are aligned. It's not just, hey, I want to do a deal to and get it, try to get a bonus. It's based on how well we do. Also, when we talk about alignment, I'm usually one of the biggest investors in all of our deals. And like I said earlier, the team invests as well in our deals. So we manage every decision with the same discipline and diligence we expect for our own capital. So, like I said, market expertise, only focus on a few markets so we could be experts in in our markets. Here are our four full cycle exits. Joe?
Thanks for that, Gary. As Here's a snapshot of our current portfolio. Um, in the previous slide, Gary mentioned that we currently have 9 properties. They're primarily in the Tucson MSA. And we've also had 4 full cycle exits, but here's just kind of a snapshot of what we have going on right now. And you can see that while the properties varies in size, anywhere from uh, 42 units, all the way up to 256. And then the one that we're going to talk more about later tonight is 300 units. It's a pretty large property. And they all come with, various value add plans. It could be from light value add, to very deep value add with new construction. But the focus, what I really want to point your attention to is the focus on workforce housing. Despite the differences in the properties, they're still primarily Class B and C workforce affordable housing, which is what we specialize in. And just a little bit more granularity on our full cycle exits. These are the 4 properties that Gary mentioned in previous slides. And you can kind of see just sort of on average, we've outperformed our projections. So just to kind of rat off a few stats here, on average, we were able to achieve a 49.5% internal rate of return versus 16.25% projected. And then on the equity multiple, we were able to deliver to our investors, and this is net of all expenses, 2.08 times versus 1.99 times. And the other 2 things I really want to bring to your attention is that if you look on the third property that we sold, Midtown on Seneca, we have sold this property at the peak of the recent bull market, and you can see the outrage. I didn't want to say outrageous, but you can see that, we had a pretty spectacular return. This is 101% IRR and over 3x equity multiple. It's just, pretty insane numbers. We don't make those kind of projections ever, but it just goes to show you that when we have the tailwinds, the macro forces on our side, we can really hit it out of the ballpark, so to speak. Now, on the other hand of that spectrum, we the last deal that we sold, Midtown on First, we sold that in a bear market. And even when things, with all the macro forces against us, we were still able to beat our projections at 19% IRR versus 18, and equity multiple sort of in line. So, we were pretty proud of those accomplishments in very differing markets. Okay, so now we're gonna start to get take a deeper dive on our latest opportunity, Icon on Broadway. In the next few pages, I'm kind of just gonna give you some high-level overview, and then after that, I will turn over to our asset manager, acquisition manager Tim, who will really dive deep into to the numbers. Okay, so Icon on Broadway is a 1980s vintage 300 units that we're going to be purchasing for $33 million, dollars, which is approximately $110,000 a door. And as Gary mentioned earlier, it's been a very long time, several years that we've seen a deal like this. Um, we're going to be putting on approximately 75% leverage on this deal. And we will be using a 5-year fixed rate loan. This is a Class B workforce housing, just like the 9 previous ones, actually really 13 that we own, operate, sold. There's strong demand for this property. This is an off-market acquisition, as Gary mentioned earlier, and we're basically buying it at less than 50% of the replacement cost. So they would cost more than 50% of this price to build this product today. We're projecting a 16% internal rate of return and a 1.9 times equity multiple. You should expect to receive approximately 80% or better bonus depreciation. So that means for every $100,000 that you invest, you will receive $80,000 in or I should say, yeah, tax deduction, assuming you can use it right away. And we are also underwriting very conservatively. For example, we're assuming 0% rent growth in year one. And with all that said, we expect to be able to distribute very strong cash flows out of the starting gate at approximately 6%. I also want to take a moment and really just talk about market risks or just risks in general. There's a lot of uncertainties out there. I just want to kind of uh, let our investors understand that, these are things that we track carefully and are very aware of. This is something that all, real estate operators are facing today and must be able to, have an answer to these items. So one is, I kind of mentioned earlier, we definitely have been seeing slower rent growth, just, due to the stagnation of economic growth. And so with that, as I mentioned earlier, we're assuming 0% rent growth in year one of our projections. And this is probably something that a lot of people have heard about, which is expenses are just going up, insurance, payroll, utilities, and these things are these items are things that we're dealing with, that we've been dealing with, last couple years. And so we built into that the much higher cost in our pro forma. Another one is the interest rate risk, and then also the implication on where we can exit. Interest rates have been elevated. It can be volatile at times. So although we have an opinion on where we think interest rates might go, we're not going to take on that risk. We're just going to stick with 5-year fixed, just so that it's a known quantity. And finally, um, this is a pretty big property, 300 units, and but it's something that we're very comfortable with. We have 9 big properties, in the area. We have a very good working relationship with a institutional quality property manager, and we're one of their bigger clients, so they do give us better attention. But not only that, though, we also rely on them to provide us with a second set of eyes. We want to make sure that, we come up with our pro forma, our business plan, and basically just, checking it with what their vision is to see, where we're lying and where we're not and why not. So just having that second set of eyes really helps kind of validate our projections. So Gary mentioned earlier that the last two acquisitions that we had were more core, maybe sort of the light value add type of properties, meaning, instead of taking on something that requires a lot of uh, work, and we're trying to minimize risk in this environment by taking on properties that don't have a ton of deferred maintenance or don't require a significant amount of repairs or renovations, and really just going for stuff that's trying to buy it for as low as cheaply as possible, taking advantage of market conditions and not really taking on too much risk. And so in the scale of different value add business plans, this would be on the lighter side. And so these are just some examples of what we're going to be doing. One is that we're going to be rebranding the property to Icon on Broadway. We're going to have new signage. And basically, this is an indication, this is a signal to our tenants, as well as the overall, market and then the curb appeal that, hey, there's a new ownership in town, and we're going to be doing things differently. And it's just, it's a signal that there's improvements coming. Some of those improvements that we have earmarked are like things like providing a package locker. When we did our property tour, noticed that there's a really nice, convenient area right next to uh, the the mailboxes, and it'd be really good. I mean, everyone these days have so many Amazon and other packages come that I think the tenants will really enjoy having, that amenity. As well as, there's various like green areas where you can add pergolas, barbecue picnic areas, just to, provide additional amenities and enhancing uh, use of these things for our tenants, which ultimately we believe will increase retention. The property right now has kind of this like outdated, like greenish, tannish, very traditional color, and we're going to be updating with a more modern color scheme. And finally, as we do with all of our properties, it's looking for areas of cost improvements. Where we can reduce payroll and just general G&A, and with our scale, we're able to enjoy the lowest property management fees that's available to operators like us. So with that, I'm going to turn over the next few slides over to Tim, our asset manager.
Thanks, Joe. Yeah, so this is our capital stack and our sources and uses. So on the left, we have kind of a table. If you've invested with us, this breakdown should seem pretty standard and familiar. So we have about just shy of $10.5 million of common equity between the three classes. And then right under that, we have our preferred equity partner, which is just over $3 million. So the common equity would be around 27% of the total value that we're investing. And then the pref equity will be just under 9% at 8.6%. So the senior debt will be around $24.8 million, or 64% loan to value, which we feel like is a very appropriate loan to value percentage for this deal. On the right side, it goes into more detail on the uses. So, we have our purchase price. Originally, when the broker came to us and the select few of potential investors. As Gary said, this was an off-market deal. The original, starting bid was at $36 million. So we're able to trim it down to $33 million. And the closing costs, other miscellaneous fees, they should be pretty standard. CapEx, which is the next slide we want to get into. I'll go into more details on that. So slide 16, please. Yeah, so the two important roles or purpose of CapEx is to either augment revenue through various stream of providing value to our residents. So, if we're providing value that they're willing to pay for, that goes into, our end result in terms of being accretive to our income and ultimately our returns for the investors. So whether it's amenity upgrades, interior unit upgrades, or smart home devices, these are all ways that we can increase, revenue stream through CapEx. The second role that isn't as talked about is to preserve capital. So in preserving capital, we need to spend money to preserve the condition of the property so that residents will continue to stay and new prospects will want to live at a nice property that's well maintained and, have great landscaping and the paint is good and refreshed. So those are all things that, some of the CapEx money will go into. And then lastly, when we maintain the property and when we keep it in good condition, that helps us with our exit value, right? More people want to buy it, and people would know that the property's been well maintained in terms of systems and infrastructure, that they wouldn't need to spend as much money to fix it up. Some of the big items that I want to highlight, we had our physical inspection and due diligence on January 5th. So, everybody on our team, we were out there walking the property most of the day. Our property management company, they had probably 15 to 20 people, split up into multiple teams, walking 100% of the units, taking notes, making sure that, everything is accounted for. We did lease audits on, nearly 300 leases to make sure that all the numbers are correct, that everything are supposed to be charged. So while we're doing that, we come up with, a list of things that we want to game plan to repair or fix or invest in. So one of the bigger items is, you can see towards the bottom, it's the boilers. So these boilers they're aging, right? We really want to make sure that our residents can get hot water quickly. One of the complaints we have at the property is that, the further you are from the boiler lines, it takes a little longer to get hot water. So we want to make sure we upgrade that to make sure that, our residents have the best experience possible. And these are just part of the routine deferred maintenance that, we budgeted for as we underwrote. Next slide, please. So this is kind of our detailed pro forma, which is our cash flow projection for the property. So the top quarter is income and the bottom, 2/3 is kind of the detailed expenses that, we're assuming. So, few things that I want to highlight, as Gary and Joe already did. We're very conservative, especially the last, quarter or two we've been underwriting. So year one, as Joe mentioned, we underwrote 0 rent growth. As we know, rent growth in Tucson has been pretty flat the past year. So we want to make sure that we're not assuming aggressive rent growth to achieve the return we want to achieve. Net operating income. So the compounded annual rent growth for NOI at the very bottom line, it's about 3.9% annually, the CAGR. More importantly, our annual rent growth average for years 1 to 5, it's only 1.7%. So we're not, being aggressive and speculative about how much rent growth we can achieve. We're really, really trying to achieve returns through controlling expenses, which we have a great track record of doing. Those are things we can't control, right? We can't control rent growth. We can't control where the market is, but we can control in large part the expenses and how we want to operate the property, and really going in depth with, how to control those expenses. So year one, and this is might be a little technical, but 40% of the operating expense, so 40% of the NOI, or 40% of the total revenue is operating expense. And throughout, the 5 years that we're holding it, we're trimming that down to the mid 30s. Right now, the property is probably in the low 40s. And then once we buy it, because we have AI leasing, because we have scalability, as Joe mentioned, we have another large property about a mile down the street. So we're able to create efficiencies with operating two properties and proximity. We can have floaters for maintenance. We can have floater for leasing. We can have housekeepers that go between the two properties very easily. So those are things that, only we can kind of achieve because we have density and scalability. And then another thing we want to highlight is the insurance as we underwrote it. Because there was a fire in 2023, in October of 2023. In October of 2028, that will officially come off the 5-year look back. So in 2029, which is year 4 of this analysis, our insurance expense will, drop pretty significantly. So that's another thing that, we really like about this deal. It's right now, like on the exit, we're able to realize that gain through just organic, savings from the lower premium from insurance. Next slide, please. So this is a picture. These are examples of some of their renovated products. As we toured the property, and I've been there quite a few times because it is a comp for our Icon of Spanish Trail, which is down the street. So around 85% of all the units have been either fully renovated or partially renovated. And, the first time I went on the property, I was a little bit confused because, most of their partial renovations are the equivalent of full renovations for a lot of our comp set. So basically, they have a nicer finish, and our partial renovations is basically other competitors' full renovations. There are smart home devices on 100% of all the units. So we have smart lock, smart thermostat, and the residents are willing to pay for it. They're charging $40 a month for these. So that's another pretty unique offering that we have for River Oaks or Icon on Broadway. So unit mix, about 9% of the units are studio, and then 43% are 1-bedrooms, and 48% are 2-bedrooms. So we feel like this floor plan is very, very it fits the submarket really well. We're not particularly close to, a lot of schools. So typically we like 2 or 3 bedrooms, but because we're so close to so many employment centers, I think having half of the property being studios and 1-bedroom is appealing for people who want value. And obviously there's some families in there as well, but we feel like this floor plan is very optimal for this property. Next slide, please. So these are some of the rent comparables. As you can see, we're one of the lowest per rent per unit, and we feel like there's a lot of value and upside to be had because of the loss to lease, especially because once we have all the upgrades and the amenities, and once we're done deploying our capex, we definitely have a much higher pricing power, and because this property is a comp for Icon of Spanish Trail, which we own, I'm very familiar with the historical operations of this property. And Icon on Broadway is always either number 1 or number 2 in terms of occupancy. It's always in the mid 90s. So we feel like, the property has been operating really well. People like living there. People like leasing from there. And another thing that's really appealing about this property is it's located on Broadway. So we get about half of our traffic from leasing from walk-ins, which is really popular in this submarket for walk-ins. Next page. So there's a sales comp, and as Gary mentioned, we think $110,000 per unit is really, really great value. And when you get down to the per square foot price, around $156, that is, really, 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 really competitive. Right now, as we talk to developers and brokers, it's about $300 to $350 a foot to build a brand new product. So as Joe mentioned, it's less than 50% of replacement costs, which we think, with tariffs and inflation, with the cost of building going higher, I think the value for owning right now, it's only going to be more appealing to investors down the road as we sell the property. Next, please. And as a lot of you guys know, Tucson is a great market to invest in. We think the Sun Belt overall has been great, but Tucson, because we get a lot of people who are priced out of Phoenix coming down here, and obviously, as we go into the next slide, the employment base for Tucson, especially this submarket, is very strong. More than a quarter of people who live in the submarket, they are employed nearby by the medical centers. So that's very providing, recession-proof demand for our rental housing. As you can see, a lot of healthcare, finance, and aerospace is another big industry in Tucson. So Raytheon just got a really big contract from the federal government, and whether that's because geopolitics or, escalating tensions with other countries, that really benefits Tucson because of the defense and aerospace industry. And then another big one is University of Arizona. They employ around 14,000 employees. And then also there's a big Air Force base, Davis-Monthan. They employed around 11,000 employees. So all three of these are recession-proof, in addition to all the medical employment that we have in the submarket and Tucson overall. So diverse, non-cyclical employment, we believe that reduces volatility, and it supports occupancy, and we believe that contributes to stable rent growth. And obviously, with the ongoing University of Arizona investments, their continued growth into research, the defense and aerospace spending, that further strengthens, our position in the market. Next, please. So this is kind of a high-level map of where Icon on Broadway is. We're on the bottom right. So you see Broadway, which is one of the main thoroughfares that goes through, it's east and westbound in Tucson. There's a lot of amenities, retail, entertainment, shopping nearby, just on Broadway. So we feel like it's a very convenient location for renters to get to, their work, to go shopping, to go out to eat, to go to movies and entertainment. Next.
So I'll take it from here. Thanks, Tim. So Tim's covered why we like this location, or why the location works, why we like the asset in the market. So what I want to focus on now is how investors can participate, how the different investment options are structured, and how returns actually flow back to investors. So starting here, we'll walk through the investment, starting on this page, we'll walk through the investment classes, projected returns, the waterfall structure, and the investor timeline. So you'll see on this slide that there's 3 different ways investors can participate in this deal. These are designed to meet different investor goals, whether it's income or upside. So Class A is preferred equity. It provides a fixed 10% annual return with monthly distributions that are designed for investors who want simpler economics and steadier income, but it doesn't come with bonus depreciation. Class B is common equity, and this is the most common option investors choose. It balances current cash flow with long-term upside and tax efficiency. And then Class C is intended for larger investments with a minimum of 500,000. So it has a slightly higher return target and a simpler profit split at just 80-20 the whole way. So that you can see in the waterfall row there. So across all these classes, investors are paid first. So in the common equity classes of B and C, we use a European waterfall, which means investors receive their preferred return and capital back before the GP, which is break of day capital, participates in any profits. In Class A, since there's no profit participation by the GP at all because there's just no profits, it's a straight 10% fixed income. One other important clarification I wanted to make was in terms of the preferred return. So preferred return doesn't mean it's guaranteed cash flow. What it means that if cash is available, which we expect that there would be on a quarterly basis, investors are paid first, and then unpaid preferred returns are accrues over time. So just wanted to make that clear. So this slide is it's a projected Class B return example. So this slide shows an example of what a $100,000 investment in Class B would look like over the whole period. So you can see in the early years, most of the return comes from cash flows or distributions, which starts around 6% in year one and grows as the business plan is executed over time. So you can see that the majority of the return is realized at sale when investors receive the remaining capital back plus proceeds. So in this example, 100,000 investment results in approximately $190,000 total cash back over about 5 years. So it's the original $100,000 investment plus the 90,000 in distributions that investors receive over time, plus the proceeds from the sale, which is at 60,000 you see in the year 5 column. So keep in mind, these are target returns, not guarantees, but they reflect how we underwrite conservatively, and we're trying to avoid overly aggressive assumptions in our numbers. So this slide, it depicts how the Class B waterfall works. So as I mentioned, we use a European waterfall, which means investors get paid first before the GP or break of day capital gets paid. So this is an important slide because it explains how profits are distributed. So as I mentioned, in a European waterfall, it means investors are paid first before the GP participates. So distributions are calculated at the deal level. That means investors receive the preferred return and their capital back before the GP earns the promote or the carry. So what that means is for Class B investors receive the 7% preferred return first, and until that point, the GP receives nothing in that phase. After that, after the 7%, profits are then split 70% to the investor, 30% to the GP until there's a 15% IR that's achieved. So if we hit the 15% IR, then after that is when the profit splits move to 50-50. So if the deal doesn't, so the way this is structured, if the deal doesn't perform, then we don't get paid as the sponsor. So it's that alignment that Gary was talking about in the beginning, that it's intentional and it's central to how we structure our deals. The next slide is Class C. So it's similar to Class B, but it's really just showing that Class C has the 8% preferred return versus a 7 in Class B before when investors get their capital back before their GP participates. And as I mentioned before, the Class C, the waterfall profit split's a lot more simple. It's just straight 80-20 after the 8% preferred return is reached. So there's fewer tiers here. So we have some investors that prefer larger allocations and they'd like a more simpler structure. So that's why we have the straight 80-20 split the whole way. So just keep in mind, regardless of class, the GP, break of day capital, we don't get paid until investors hit these marks. So performance comes first in all of our deals. So the next slide is, we talked about earlier with this investment, you can expect in year one at least an 80% bonus depreciation loss on your year-end K1. So this slide explains why bonus depreciation matters, not because it changes the deal, but because it changes how long your money stays invested. So in this example, a $100,000 investment generates roughly $80,000 of bonus depreciation loss in year one. So for many investors, that could translate to about 28,000 in deferred taxes, depending on individual circumstances. So that capital can then be reinvested instead of going to pay taxes. So investors can continue earning cash flow and participate in appreciation by using this 28,000 in investments rather than paying in taxes. So This effectively results in a higher equity multiple and higher IRR, even though the deal itself hasn't changed. So moving to the next slide, it shows another view of how this tax efficiency works over time. So both lines in this chart assumes that it's the same pre-tax return. The only difference is whether capital stays invested or if it's paid out in taxes along the way. So over time, you can see that it compounds meaningfully. So this is why real estate can outperform other asset classes on an after-tax basis, even with similar top-line returns. So this is also why we focus on conservative underwriting paired with tax efficiency rather than stretching assumptions and trying to make as much gains as we can by taking a lot more riskier path, because we know the tax efficiency part also adds to the investment as well. And then slide 31 just talks about the timeline. So just wanted to lay out this slide for key dates to make sure investors are aware of. So the fund opens today, January 21st. So non-accredited investors can participate because we're currently under a 50B structure, but that lasts until February 6th, and provided there's a pre-existing relationship, which simply means that we have to have a substantial conversation before you invest. And then after February 6th, the offering transitioned to a 506C, at which that time the fund will be, or the investment will only be limited to accredited investors only. And then we expect to close in late March. And then after that, investors can expect to receive monthly email updates on the 25th of every month, and then expect to receive K1s annually by the end of March. So that's a quick timeline of what this process is now. So just to recap the quick investment highlights. So this slide brings us back to the fundamentals. So this is a well-located Class B workforce housing that was acquired off-market at a basis more than 50% below replacement costs. We assume 0% rent growth in year one, and we still underwrite to a 16% IRR. So it's that conservatism is intentional, as Gary and Joe mentioned earlier, and Tim as well. Rents have been sort of flat in the Tucson area recently, so we're going into this deal being conservative as well, not assuming rent growth in year one. And even as Tim mentioned, over the average over 5 years was, I believe, 1.7%. So prior, maybe a couple of years ago, you'll see pro formas and people are assuming 3 to 5% rent growth per year. So in this case, we're assuming under 2% average for the 5 years, and we're still able to underwrite to a 16% IRR. So we structure our deals to make sure investors get paid first, as I mentioned, so the European waterfall. So your capital comes back first, and we, the GP, we only participate in upside after performance is delivered. So next steps is the last slide. So if you're interested in moving forward, the next steps are straightforward. You can register in our portal using the QR code at the bottom of the screen, or you can go directly to our website. So that gets you set up in our system. I'm also going to put a link to be able to register in the chat right now. So make sure everyone, if you want, you can just click that link you see in the chat, and that's another way to get started. So once you sign into our portal or enter the information and the QR code link, so the second piece is you can submit a non-binding soft commitment. So you'll see a button that says soft commit. So this doesn't obligate you to invest or doesn't obligate you to wire funds. It simply helps us gauge interest and reserve an allocation as we finalize documents as we head towards the March close. So once documents are ready and funding officially opens, you'll receive a notification through the portal or through your email with everything you need to review all the documents. And also at that point, we'll give you wire instructions. So when the documents are ready, investors can take a look, review the materials, and you can always ask any of our team members questions. You can set up a call with me, Gary, or Joe, and you can ask us any questions you want after the documents come out. So just keep in mind throughout this main process, I can be your main point of contact. So if you have any questions, need clarification, just reach out to me directly at andy@breakofdaycapital.com. So that's it for us, or for me. So we appreciate the time you spent with us tonight. I think we can move on to some Q&A questions now.
So Matt asks, what was the cause of the fire? Is there a probability another fire may occur? Tim, I don't recall I think it was, just a tenant mistake fire, and so low probability. But correct me if I'm wrong.
Yeah, yeah, it was a kitchen fire, and I believe only 4 or 5 units were impacted.
All right. And Matt, that does, I mean, we've had where it's we've had one unit go down at some of our other properties. It happens. Sometimes it spreads a little bit more, but you know, unfortunately, people make mistakes. But that's what insurance is for, and also tenants also have their own insurance too, which could cover it. But obviously, in this case, the property owner's insurance covered it, and it'll. The beauty of it is we're paying for it being on the expense, and we're going to get the benefit of it coming off before we sell, which will really boost returns. All right, what is the T12 cash on cash? So the first year, I'll go back to that slide. I think it was 6% in the first year, and then it'll grows from there. So we have what is the co-GP investment in this deal? We'll probably have about $500,000 from me and the team on this deal. What is the profile of the current owner? Tim, you want to take this as well?
Yeah. So the current profile of we can't disclose the seller, but they're institutional, they're European based, and they're actually exiting a portfolio of 7 or 8 properties in the US. And that's partially the reason why this deal is off market, because they have a deadline to fund something else, or a mandate from their investment committee to exit all the deals by a certain time. Yeah.
Can you clarify the project is to be sold at 5 years? We typically underwrite for 5 years. I would say 3 to 5 years is when we'll sell it. We want to maximize where we are in the market. So some of the deals that you've seen, we sold within 2 years because the market was on fire and we took advantage of it and locked in those gains. Some of the deals we bought in 2022, they're gonna be held a little bit longer. So it really depends on the market, so we could take advantage of it and maximize returns for investors. Any other questions?
The current occupancy is 93%. And the 5 year, it's interest only.
Yeah. And just so you know, on that loan, we've gotten several um loan quotes, and that's the one we prefer the most. But we are looking at other options. So we have another question here. Can you expand your thoughts on multifamily market in Tucson in general? Yeah, it's certainly we haven't had the rent growth that we had hoped for in the last 2 years. But projections are significantly higher than we underwrote for starting in Q3 of 2026. So, Tim talked about zero rent growth in year one, and I believe the projections when you combine CoStar, RealPage, and Yardi and take the medium, it was an average of over a 3%. I'm pretty sure. I don't know, Tim, if you remember, but so we're way under what they project. Certainly, we've also had more concessions and delinquency than we've had in the past. That has been slowly burning off, and as you have more absorption in the market too, that will also burn off as well. So We are still very, very optimistic on this market, particularly with our economies of scale as well. It gives us a significant advantage.
Yeah, and I think to add to that, you know, Tucson in terms of the market, I think if you underwrite new deals at this point in the cycle for to have speculative demand, as in, hey, we think we can renovate a unit for 12 to $15,000 and get $250 a premium, like it's not gonna pencil because the rent growth is just not there. The spread between classic units and renovated units have just been too tight. So when we underwrote this deal, what we did is we didn't speculate demand. We leaned into current demand and we just want to operate and make the property, operate more efficiently. So in that way, I think we really de-risked ourselves from traditionally how most investors underwrite deals. So that's a key difference as well.
Chandra, that's a really good question. So she was clarifying it. Is the trailing 12-month cash on cash return? Yes, we don't raise extra money to give it back to investors. This is after we pay our debt, this is the remaining cash that we will distribute. This presentation will be available to view. It'll be in the portal. Tim, maybe you know this question. I would assume it's fairly low, but the question is approximately what percentage of market share of Class B will Break of Day have with this deal in the immediate area?
Yeah, I mean, I don't really know the answer to that because I don't know if you're asking about submarket or 1 mile radius, 3 mile radius, but we'll have between this deal and another deal, about a mile down the street, about 556 units between the two. Um, so I'll approximate like less than 5% of, a 2, 3 mile radius. So not substantial.
And then a question on occupancy. What are you seeing for delinquency or economic occupancy? Tim, do you want to take that as well?
Yeah. So, we've underwritten really conservative delinquency and actually increased delinquency and concessions because we know that potentially there's supply, a few miles away, even though it's Class A. What we've seen is that Class A and luxury products, the concession and the kind of the vacancy kind of trickles down. So Class A minus B plus residents will start to chase the concession for Class A and luxury products, and Class B plus B minus is going to backfill the Class A. So concession will kind of trickle down that way. We've seen that in some of our existing properties. So, we've been pretty conservative with, you know, concessions and bad debt. And we have pretty good intel because we have a property down the street. And what we've underwritten is, just north of what they had in terms of bad debt and collection loss. Concession we have, pretty much throughout the hold, even though we know that, once the supply gets leased up, there's not a lot of, pending permits or new supply coming online after the next, 18 to 24 months.
And this is a superior location to Spanish Trail because, as Tim said, it's on a main road. There's a ton of great stuff, retail, and you got In-N-Out Burger, Home Depot right across the street, PetSmart, Sprouts. So some great retail, right, stone's throw away. We got another question. What is the forecasted cap rate at exit? It's 6%.
Yeah, so another big thing when we underwrote the deal is we didn't want the return to be off of the exit cap rate. So we pretty much kept it the same or similar to going in, maybe slight compression, but we're not going to assume a 5.5 cap rate. So we feel like that's a very appropriate number.
Well, I want to thank you guys for coming and listening to our opportunity. Great way to start the year with a tremendous opportunity. Um, I hope you strongly consider it. If you, like I said, if you have questions, feel free to reach out to Joe or Andy or myself. We're happy to answer any other questions. The docs should go live in about a week, but we'll notify you. And have a great rest of your night. Thank you.